The reality of IRS tax collection in 2023, implications for the economy and markets. Recently, there have been numerous posts circulating on social media claiming that the IRS collected a record $4.9 trillion in taxes in the past year. However, this information is not accurate, and the actual situation is even worse. In the next few minutes, we will delve into what really happened with the IRS and tax collection in 2023. Additionally, we will explore the consequences of this shortfall and its potential impact on the markets. Clarifying the misconception. The confusion surrounding the IRS tax collection figures stems from a post published by the Journal of Accountancy on January 4, 2024. Many individuals misinterpreted the data, assuming that the $4.9 trillion mentioned in the post referred to the previous fiscal year. However, this amount actually pertains to fiscal year 2022, as indicated on the Federal Reserve's website. The reality of tax collection in 2023. Contrary to the misconception, tax revenue actually declined in 2023. According to the federal government's website, fiscaldata.treasury.gov, the government collected a total of $4.44 trillion in taxes during the fiscal year 2023. This figure represents a decrease from the $4.9 trillion collected in 2022. Implications for the economy. While the initial reaction to the decline in tax revenue may be positive, it is important to note that such a trend is typically associated with severe economic pain. Historical data from the Federal Reserve reveals a consistent pattern. Whenever tax revenues decline, a recession follows. This correlation has held true for the past 4 decades, with the exception of the 1991 recession, which occurred alongside stagnating tax revenue. The link between tax revenue and recessions. It is crucial to understand that the drop in tax revenue does not directly cause a recession. Instead, it is likely that a third factor or a combination of factors leads to both declining tax revenues and economic downturns. Factors such as reduced consumer spending, increased unemployment, and higher levels of debt contribute to both lower tax revenues and recessions. The national deficit and increased borrowing. To compensate for the decline in tax revenue, the federal government must rely on borrowing to cover its expenses. The amount borrowed each year is referred to as the deficit. Year-to-date figures indicate that the government has borrowed 133% more compared to the same period last year. As tax revenues continue to fall and the recession persists, the government will need to borrow even more to bridge the widening deficit. This increased borrowing will likely lead to higher interest rates, as the demand for lending to the government outpaces available funds. Long-term economic trends. The current economic climate aligns with a long-term cycle that lasts approximately 40 years. From 1980 to 2020, interest rates and inflation steadily decreased. However, this trend reached its lowest point in 2020 when interest rates hit 0%. Moving forward, it is expected that both interest rates and inflation will begin to rise again, marking the start of a new phase in the cycle. While there may be temporary reversals, the overall trend suggests higher interest rates in the future. Conclusion. The misconception surrounding the IRS tax collection figures for 2023 highlights the need for accurate information and analysis. Contrary to popular belief, tax revenue actually declined in 2023, which is typically associated with economic recessions. The government's increased borrowing to cover the deficit will likely result in higher interest rates. While these developments may seem concerning, they also present opportunities for savvy investors to capitalize on potential deals and leverage inflation to build wealth. Understanding these dynamics is crucial for navigating the current economic landscape.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.